Hello, everyone. Welcome to this week's episode of Zero to One. We're up to episode 21 now, which is kind of mind-blowing. 21 weeks of doing this. We've been loving it so far. I think it's been really good. There's been some amazing sessions with a variety of different speakers covering different topics. So we know that our member base is broad. You may be a freelancer or a fractional executive. You might be a founder, or you might have an ambition to be a founder. Maybe you're still working in a larger business, but you have that itch to go out and do something of yourself as well. So yeah, we love to welcome you all, and we'll keep putting out content that we can as most relevant for you. As ever, we're always keen to get your feedback, so do let us know, after these sessions, what you'd like to hear more of, because I know with our guest today, he's got 100 things he could tell you about in that sense across all different areas of business in that sense. So we could certainly do another session in the near future as well. So yeah, very excited to get kicked off. So I welcome Colin here. So Colin is the co-founder of Scalar and Huckham Launchpad, and has worked with hundreds of different startups and also businesses that have hit unicorn status as well. He's been working like a machine in this part of the world. I think he's got the guns as well.
Oh, that's it, mate.
And yeah, really excited to get him on. Actually, we was hoping to do this even sooner, actually, but I'm really glad that we can now have him share his wisdom with us as well. So thanks, Colin. I'll let you kick off. And as ever, just last piece of housekeeping, I guess, for those who may be joining us for the first time, please feel free to put any comments in the chat. If you want to ask any questions, there's a Q&A button at the bottom, so you feel free to put it in there. And the benefit of that is that obviously goes to us both, so we can have a look at that. We want to make this a bit of a conversation type session today. So if you want to also raise your hand and I can unmute you, you can ask your question verbally. You don't have to type it in if you don't want to, or if you want to share your own points of view as well, very welcome as well. So however you're most comfortable, really. But yeah, without further ado, I'll let you kick off, Colin.
Yeah, thank you. Thank you, Big Dog. And thank you, everyone, for coming to join and listen to my tirade. I will be honest, I am still a tiny little bit jet lagged. I just got back from London. That said, I'm looking forward to doing this presentation. And I also added in a special little treat that I was asked about last week. So I was in London last week, or as I now like to call a poor man's Sydney, and I was doing a presentation for HSBC Innovation Banking, which is basically the old Silicon Valley Bank who collapsed. Thank you, guys. And then they were acquired by HSBC in Europe. So they asked me to come and do a presentation on how to scale tech companies. And I spoke about something that I'd never actually spoken about before, but it's something which we did within my own business. And I had four people come up to me afterwards and ask me, how does that actually work? And what I'm referring to is how you can actually enter a new market by spending absolutely zero, doing no money down deals. So I figured after I had three people in the audience ask me that, and then I actually had HSBC come up to me like, how did you do that, man? I decided to actually put that into a presentation. So I'm happy to cover that bit at the end. But other than that, let me go and kick it off. So a little bit of an introduction. The bold mo you see in front of you, Colin Kleine is my name. A little bit of background to me. So I'm one of the co-founders of Scalar, and we recently also launched Hook'em Launchpad. I won't give you the entire spiel and collateral, but in short, I've been working with helping tech companies to scale for about 14 years. So I've worked with about 500 startups, 48 unicorns. I'm an LP in three funds. For some reason, governments asked me to come and advise them as well. So their problems are their own, but I'll take the money because Singapore's expensive. But I guess my expertise really, having worked with so many different and successful technology companies, I've seen what it is that they do that is different. And then we took that formula and we applied that into our coaching business as well as to Accelerator that we've created. So my main business, Scalar, we're a management consultancy. We specialize in go-to-market, both executing go-to-market, so helping companies basically to make sales and enter a region, as well as go-to-market recruitment. And late last year or early this year, I partnered up with a phenomenal British entrepreneur who, by the time he was 30, had started, scaled, and sold three SaaS companies. And we started our own accelerator. combining both parts, where he knows how to build products that will go on and sell, whereas I know how to scale. He's far more impressive than me, but I talk more than he does, so that's where it works. To kick it off, one of the topics that I've been asked to speak on, I guess recently, it is market expansion, market entry. And in particular, probably the two most popular cities for market entry and expansion, which is Singapore as well as Dubai. And this week in Singapore, Super AI is in town. So I guess I just wanted to start off by actually covering why both regions, what makes them unique, how to make money, et cetera, et cetera, et cetera. So without further ado, there he is. Look at that stallion. So what I'm going to do is compare the regions, major considerations, how to do it, scaling hacks, and then if we've got time, I'll tell you how to do it without spending a single cent. So long story short, if I was to compare the two, MENA, so Middle East, North Africa, the major commercial and economic hubs, to get straight to it, is pretty much Dubai and Riyadh. Industries, it's probably no surprise, oil and gas transportation, given that so many of the world's leading airlines are there. Tech, it's quite interesting because they're doing a lot in robotics, they're doing a lot in AI, they're doing a lot in data centers, but they're also learning a lot from us here in APAC. So in APAC, I mean, it's hard to even pinpoint what's our major commercial hubs, but it'll be anything like Shanghai, Tokyo, Seoul, Singapore, Sydney, et cetera, et cetera. That said, the industries are a lot more diversified, and I'd say that financial technology and consumer electronics, we really dominate in Asia Pacific. What makes APAC great? The GDP is higher. It does have a higher population. There is a lot more venture capital funding, so significantly more than what you can currently get in MENA. There's been a lot more unicorns, and the most important one, it's got salted egg. Then if I was to contrast it to the MENA region, as someone who has recently incorporated his business in Dubai, I'll be honest, I thought Singapore was easy. With Dubai, I've never seen anything quite like it. I think you can incorporate it within an hour. So they're very hungry for business. And because Singapore is basically the financial and the commercial hub of Asia Pacific, it's pretty much smack bang in the middle of the continent. If you're coming into APAC, Korea, Japan, amazing markets, but they're very, very far. Australia, I'm obviously going to be biased, great market, also very far. Singapore, smack bang in the middle there. They're both relatively small markets of themselves, but they provide the connectivity to the rest of the wider region. Dubai, however, has a couple of advantages. Singapore's got a couple of different advantages, but Dubai in particular right now has got their golden visa rule, where if you incorporate your company there or you're a C-level executive, it means that you don't need to pay any personal income tax. That's right. You don't pay any personal income tax. Now, tell most Australians this and they'll probably snap your arm off. The conditions are you just need to visit the country or the city twice. So there's a lot of things that are quite attractive for them to be bringing businesses in. It's also very, very venture-friendly regulation. You can get a VC off the ground relatively quickly. They've got a lot of regulation to make it easy to sandbox and test, whether it's crypto, some new age financial technology, artificial intelligence. It's a lot easier to hire at the moment in Dubai. Reason that I say that, so Singapore has obviously quotas, so whether it's employment passes, et cetera, whereas in Dubai, I was quite surprised to know that only 9% of the population are actually Emiratis, and it's 91% expat. So it's not a condition which they have at the moment. That said, if you're looking to do business in Europe, go to Dubai. If you want to do business in Asia Pacific, I'd still say go to Singapore. But to cut straight to it, they both have their own unique pros and cons. One thing that I'd say is the amount of wealth in Singapore and Asia doesn't get spoken about anywhere near enough, in my opinion. Asia Pacific currently has 40% of the world's family offices. That's soon going to be 60% of the world's family offices, and the vast majority of them are concentrated in the red dot, which is also why Jamie and I pay so much money in rent because there's so many rich people here. But I guess it's also a great thing. Whereas in Dubai, there's a significant amount of family office money plowing in. So both of them have got a good venture ecosystem. It's easier to incorporate a venture fund, easier to incorporate a company, but you can still raise significantly more venture capital money in Singapore. Now, what I wanted to talk about, and this is the real crux of the presentation, it's just how to scale. So I'll give you an example. I've worked with a company called WalkMe, and it's a phenomenal story that never escapes me on how it is that the company just rapidly skyrocketed and then how they came to a grinding halt as an example of what to do and what not to do when you're scaling. So a good friend of mine, he was the former managing director of Hewlett Packard. He quit his job because it's Hewlett Packard and it's shit. And he's an Israeli guy originally, flies over to Israel, goes and meets a couple of early stage tech companies, and he's like, "Hey, I really like what you're doing. I'd love to bring your company into APAC." So the guy that he was speaking with, being Israeli, is like, do it on success fee. He's like, okay, I'll charge you 10,000 per month retainer, 0.1% advisory equity, 10% lifetime recurring revenue on deals, and 2% APAC rev share. The guy's like, do it on success fee. He's like, okay, I'll charge you 5,000 per month retainer, 0.25% advisory equity, 20% lifetime recurring revenue on deals, and 3% APAC rev share. The guy's like, do it on success fee. Now, what he doesn't realize is that it's kind of like the Star Wars meme, it's a trap. Woody knows exactly what he's doing. So he's like, all right, I'll do it on success fee. I'm going to take 5% of your company. I'm getting 85% lifetime recurring revenue on deals. And I'm taking 5% of all revenues in future for APAC. The guy's like, are you insane? I'm not paying you 85% lifetime recurring revenue on deals. Then make me a serious offer. Because why else would I do that? So it was very much a negotiation point. But essentially, what no one picked up on was the very last metric, which is lifetime recurring revenue, but also a percentage of the rev share for APAC. So they ended up negotiating $500 per month with 1.5% advisory equity, 30% lifetime recurring revenue on deals, and he got 7% of rev share for APAC. So he takes this company, which is really early stage, leverages his networks, and he lands them their first 14 paying customers in Asia Pacific. He also lands them a partnership with Infosys. Infosys loved the product and they started driving it. So that company goes to their investors in the US and it's like, look, mate, sorry, they don't say mate because they're Israeli, but if they're Australian, they'd say mate. They're like, we've just opened up a new continent and it cost us $1,000. We've already got 14 paying customers and major systems integrator in Asia Pacific. So they look like absolute geniuses. So the company ended up raising seed round, Series A, Series B, Series C. They went all the way to Series H. They IPO'd and eventually they were acquired by SAP. The company's called WalkMe. And for as long as they were in existence prior to the SAP acquisition, there's my buddy who's swimming in his pool in Southeast Melbourne. Sorry, he doesn't swim in a pool there because it's absolutely freezing in Melbourne, but he's cycling around Southeast Melbourne, making 7% of every single deal that all the salespeople in the region sign. I heard that and I'm just like, what have I been doing my entire life? The moral of the story, the way that they creatively structured that deal, for WalkMe, they got access to someone who has massive amounts of networks, extremely well connected with all the types of customers and partners that they would want. They also crafted a deal where, as an early stage company, you're not going to be paying big retainers. But instead, they crafted a deal where there's a massive hook and motivation and incentive for the person to deliver because it can create something which is life-changing. So in this case, it was lifetime recurring revenue on deals and a percentage of the rev share for APAC. So they opened up a new continent by spending absolutely nothing. He created a passive revenue stream for the rest of his life. They opened up a new market for $1,000. I heard that story, deeply inspired by it. And what I'll be speaking about later on in terms of board advisors is how we started embedding that into early stage companies. So going back to my prezzo, the mistakes that we see companies make, and I'll talk about how WalkMe started really well and then the mistake that they made is, and we see this time and time again, businesses come into a new region, but they don't localize. As an example, I've got a client which is Taiwanese and they want me to help them to open up Australia. And it sounds like a great idea, except their entire website is in Chinese and I don't understand anything, which you need to localize. And that's not just localizing the language, that's also tailoring your pricing. The amount that you could sell technology for in the UK or the US, it's going to be a different price to Philippines. So localization, even in the messaging, as an example, Australia and the US speak the same language, but it's spoken differently. I know because I was in San Francisco 8 weeks ago and I got complimented 3 times on how well I speak English. Love it. Um, it's just a different lexicon. So it's doing these minor amendments to localize it. It's also localizing the way in which you sell. So as an example, in America, you can go and use the time pressure close, whereas in Asia Pacific, you're just going to piss people off. So in Asia Pacific, it's very much people buy on hierarchy, carry business cards, have social proof, don't be pushy. It's a different way of selling. But the 3 biggest mistakes that I see companies make time and time and time again, they start by hiring the wrong leader, they overspend when they're doing market entry, and they go into a market without having any traction. And what I mean by that, they hire an absolute muppet. They burn through a whole bunch of cash. And then because they're effectively building it from scratch and have overcommitted resources, they ended up pulling out of a region. Whereas the formula that we've taken is build traction before you go into a market, establish channel partnerships, hire an expansion manager, and leverage an advisory board. Now, what I mean by that is one of the easiest ways to get traction in a market is using channel partners. Very simply put, it's companies who sell to the exact same target customer base that you do from a 100% complementary angle. So let's say we're a Singaporean company and we want to go into the UK and we sell, let's say, a human resources technology, HR tech. One of the easiest ways to do it is we identify other HR tech companies in the UK, but they have to be startups. This only works if it's done between 2 startups and roughly of the same size, where you sell to the same stakeholders from a 100% complementary angle. And you effectively speak to each other and say, let's go and collaborate, co-promote. We don't have any customers in the UK. You don't have any customers in Singapore. We can help to create referrals and introductions for you here. You help to create referrals and introductions for us in the UK. And announce that you're doing a partnership, announce it, put it on LinkedIn. It means that they're going to get a whole bunch of PR and brand awareness in Singapore. You get a bunch of PR and brand awareness in the UK. Nurture that partnership, do events and webinars, I guess kind of like do a circle and scalar. You nurture that partnership, you grow it, leads start coming in both ways, and it's pretty much like a no money down, cost-free way to get traction in a new market. We did this exact same formula for a company called Deal. So it's now the fastest growing software company in the world. They just hit $1 billion in revenue, and we were working with them from seed stage when they only had 20 people. So I opened up 10 markets for them in Asia, 5 in Europe, pretty much using this formula. Before they came into Singapore, Australia, Hong Kong, get 6 channel partners. It could be other technology companies. It could even be the government. Because remember, trade associations and government are there to help you. Grow the brand awareness. And once you've got that, now is the time that you move to the next part, which is hiring expansion managers and hiring board advisors. Now, what an expansion manager and a board advisor, to explain this into concept. An expansion manager is the opposite of going and hiring that experienced managing director to be your first person on ground. And that's the mistake that I see companies make all the time. They hire some complete muppet who's never worked in a startup on a $250,000 base. They've worked for like Oracle, SAP, Salesforce. It's completely different to a scrappy startup. Whereas what we recommend, get the traction, and then you hire someone who is working for a fellow startup in a similar sector that's 25 to 38 years old. I used to say 25 to 35, but then I kept getting older, so I keep on pushing the boundaries, but that's okay. Where they've been there for 3 to 5 years, they've been promoted 2 to 3 times, but they're not a leader just yet. So you target that person and you say, come across to us as our expansion lead. If you achieve milestones A, B, and C, you can be our head of Southeast Asia. So for that person, it's an opportunity to jump their career by about 10 years. So they're motivated. For you as a business, they already know the partners, the customers, the playbook, because they've done this at another startup. Most of all, it costs about a quarter or a fifth of going and hiring the expensive Muppet. So they come in extremely motivated. You've built traction, you start breaking even as fast as humanly possible. I layer that with when it comes to scaling, scaling goes in phases. The people that can take a company 0 to 10 are different to the people that go 11 to 50, are different to 51 to 200, are different to 200 to 1000. So when it comes to hiring, what you don't want to do is you don't want to start by hiring your first on ground, that experienced managing director, or hiring people from like large and mature companies. It's a different level of graft. It's a different level of hustle that you need to do as a startup. And this is what we see happen time and time and time again. They hire the experienced managing director. They come across, I'm going to need lead gen support, marketing support, someone to get my coffee, someone to pretend how I'm absolutely not a complete deadbeat. So before you know it, your costs keep on piling up. It's going to take them like 6 months to make a single dollar. Your revenues are ticking up slowly. So if you're lucky, you might break even by the seventh quarter or the second year. But what's going to happen is likely it'll take even more than that. So you've burnt a whole bunch of cash and your investors are going to get pissed off. And this is why we see companies pulling out of the region all the time. Where if you want to smash it in market entry, your expansion manager, the people that can go 0 to 10, hire the young, scrappy, hungry person that's already done this within a similar startup. But instead of hiring that experienced managing director, get someone like that onto your advisory board. So similar to the story that I was telling you about WalkMe, you want to get someone who's extremely well networked, who's already like VP level, who's worked for a company that's gone on to be like Series B, C, D, IPO, and you want to get them as an advisor, not an employee. On the similar kind of structure where it's low retainer, but they're extremely motivated on the back end. And that's how you can get the best of both worlds. You've got the drive and hunger to go out there and smash it, but you've also got the safe pair of hands of I know what I'm doing and I've got a ton of networks, but I'm also motivated and incentivized to use my networks. You're effectively paying 1/5 of what it would normally cost, and you're getting extreme motivation coupled with it. So what essentially happens is you break even as fast as humanly possible. We've done this very same formula within Scalar in 9 markets, which is kind of good because as an entrepreneur, I kind of practice what I preach. It took us 8 days to break even in Singapore. It took us pretty much under 3 months to break even in all the markets that we went into. And with every single one of them, we were able to do it on no money down deals. So in short, before I could potentially segue to the next part, that's the formula that we use. But in terms of a couple of other scaling hacks, I cover this in the next part on the no money down deals. You can actually JV with a company to enter a new market. You can enter a new market by securing a strategic angel investor. So if you're, let's just say, a HR technology company, you can go and secure a strategic angel in a new market that's already invested large sums of money in a similar type of technology, and that'll be kind of the impetus to kick it off. By leveraging partners and announcing it, you get free PR. There's actually also a formula on how you can like leverage local journalists to publish your story. There's a book called How to Get Free PR that you can use because we also did the same thing. We got free PR. Use partners to get product market fit. If you've got 6 partners in a market, you've just found product market fit. Focus on the small wins first. Announce the social proof so everyone can see who you are and what it is that you're doing, and then focus on getting the strategic wins as it shortens the sales cycle, and also get the traction and get the revenue before you add the headcount. And then that's the end of the first presentation. So here you can add me on our OnlyFans. So add me on LinkedIn and happy to catch up with you on book a call. As I think we've probably got time for the second one on no money down deals, I'll take a pause and let Jamie and the audience ask some questions.
Yeah, thanks for that, Colin. I appreciate that. I think, I mean, I've seen some of that bits before, so I have the benefit of being able to see that multiple times. I think one of the things I remember we spoke about on that was when you recommended, for example, the different stages of the business at the scaling point you've got that as the board advisor. But I think when we spoke about it, you said that in theory you could do that sooner, and of course you'll benefit from it. But you just want to make sure that you absolutely have that in place by that point. Is that right? Like you
Yep.
could maybe bring that forward.
Yeah. Yeah, pretty much. Like the mistake that I see companies make when it comes to building an advisory board is by and large, they appoint Muppets. um, they'll appoint academics, or let's just say, oh, my person's a sales person, or my friend's a HR person or a salesperson or something like that. What I'm talking about is on your advisory board, if you're going to start a business, if you're going to be an entrepreneur, you may as well just go big from day one. You may as well just think big.
Yeah.
If you're dreaming of one day getting a $200 million exit, then just go and get an advisory board of a person or people that have actually achieved a $200 million exit. Um, People like successfully exited entrepreneurs actually love working with early stage companies. It's what they enjoy doing. That's what makes them an entrepreneur. So you want to get someone who's actually been there and done that for a similar kind of company and be able to like you're not going to be able to pay them a high retainer. They know that you're not going to be able to do that. But if you can incentivize them really heavily on the back end, so pay something, because if you don't pay for it, you don't value it, but create that motivational hook on the back end, that's going to create that extreme motivation for them to get heavily involved. And with that level of knowledge and wisdom, it rapidly shortcuts the time for you to be able to grow and scale the company. Do we have any questions before I kick off the next part?
I had another question as well. Sorry, and then we'll see. We'll ask if anyone's got any questions. Just pop them in the button bit below. It was also around, your example, the walk me example. So I suppose I feel like if you're even if you're like a freelancer, fractional executive, something like that, you could build that kind of commercial structure in as well, right? For a business in a
Yep.
sense. Because I think this conundrum comes up quite a lot in this era that we're in, I guess, in the sense of people are worried about how to price themselves. And maybe they kind of come in and they've got a lot of expertise, but they're obviously the value they have to offer is that they're not going to be a full-time employee with all of the costs that come with it, and they're not going to charge their annual salary type thing. But I think if there is that option to say, look, if I do this project and it blows up in that sense, then obviously you want to get that recurring revenue side of things. So I could see it definitely working, not just for founders in that sense, right?
Yeah. Yeah. It's all about creating it. You have to tie it to motivation. You really, really need to tie it to like hook, leverage, and motivation. Because if you've got an advisor who's heavily motivated, it's world changing. I'm not a big fan of using equity only, because you just never know if that's ever going to get realized. Whereas something that can create a passive revenue stream, that's what we found works really well.
Yeah. And in that example though, because you said I think I remember when we spoke about it before, you mentioned that like the business was a bit surprised in the other markets that guy was still basically earning that passive income. I suppose you even as a business you could still probably put in some criteria that says, when we hit a certain amount, then maybe that reduces further, or maybe until you hit, I don't know, 10 million in revenue or something like that, to add that sort of protection. But I guess it's balancing that with the motivation bit, right? You want to make sure they're still motivated, but
Pretty much. Like, look, man, what I would say is if someone can open up a new market for you or land some major account for you, just pay them. It's something that you never would have had otherwise. Um, when I speak to businesses and I say that, a lot of them, you can see a lot of them freeze up and they're almost like it's almost like a fear of loss. It's like, oh, really? It's like, mate, you'd never have this if it wasn't for that person. If they do that, they've absolutely earned it. They've just skyrocketed your business miles, miles, miles ahead. Then what does it actually matter? Because the fact is, as long as you're making profit on that deal, keep on paying him. But it's for as long as that customer remains with you. When that customer leaves, then obviously you wouldn't keep on paying that. So as long as you structure it in such a way that you're making profit on the deal, it doesn't really matter because you're getting access to customers by paying minimal.
yeah, fair. Okay, we've got a couple of questions coming in. Well, one was more of a statement than a question from Malika, saying that you'd answered a question. She was wondering if the advisor had to have an amount to be incentivized versus future equity. And I think, actually, Malika, I can unmute if you like. I thought of you as well because she's just moved to Dubai as well, so from Singapore. So she's kind of
Yeah, Elic is great.
right in that sweet spot of what you were talking about how Dubai as a market is really opening up for entrepreneurs and things like that. So I'll just a second, I'll unmute you. Fire away, Alika.
Oh, thanks, Jamie. Hey, Colin. So lovely to have you on here. Um,
Good to hear from you again.
yeah, so yeah, I'm in Dubai, absolutely loving it. So I would like to give you my example and just see your opinion. So with the speaking part of the health concierge, I found a local partner on the ground here in Dubai who is a hospitality concept creator. So he literally builds concepts within hotels, etc., blah, blah. So you can imagine there's a ton of work for him. So what I've offered him is to plug the health concierge as an additional offering that he can offer to his potential clients, which
Yeah.
basically then that if they want to create a wellness event or a wellness experience, he has an expert in that. Is that a good offering for him, or would you have advised me to recommend another offering, like a referral fee for anyone he introduces me to?
You know what's funny? This is literally the next presentation that I'm about to do. I'm going to
Oh,
talk
that's
about
fine. I
this.
can wait. I can wait if you want.
Have you been watching it? Okay, you browser.
No.
Yeah, Elika, I'll cover that in the next presentation, and
Yeah.
then I'll tell you exactly how I was taught on how to do it, and how to create that incentivization. But a fantastic question.
Okay. Thanks.
Welcome.
All right, I'll just mute you for now, but you can always jump in if you want as well, Alika, after. Okay, so another question says, how do you test market interest without overspending or overcommitting resources?
Very easy, channel partners. If you can find yourself 6 partners, companies selling the same customer base, completely complementary angle, you've just validated. Because first of all, there's other businesses already selling to those stakeholders. And if they're interested, it's, oh, okay, we don't actually have this solution. It's actually complementary to what we're doing. And they're happy to, you need to promote them as well. So you have to promote them in your home market. Then if there's a company which is already selling to our customer base that's happy to go promote what you're doing, you've already validated market interest and you spent nothing.
Yeah, that's fair. Nice. Okay, hopefully that answers your question. It was anonymous on that one. So, but feel free to add another one if you've got it. But maybe we fire over to the next bit then if you've got it to hand.
Yeah. I'm really excited about this. I actually just made this last night, but I was asked, HSBC want me to present this. So my first time doing it. So here we go. Growth hacking, the low cost way of doing market entry. So you don't even need to put boots on the ground in a new market. You can actually do it through a JV, and I'll touch on Alika's point in a second, because why build it from scratch? And then there's another one that you can do, which is my absolute favorite, which is no money down deals, which is effectively get paid to scale your company. So the way that we do it is you need to find a business that's complementary to what you're doing, that they're already generating some revenue. Now they can be early stage or developing, but when you come in, you can kind of enhance their company. So with Elika's example, and I'll tell you how I learned this. So for those of you who are in Singapore, if you have scanned the QR codes at a restaurant, you may have ordered through a company called Tab Square. So the founder of Tab Square, Anshul, he's a good friend of mine. So they are in 15 markets, but they only have a bank account in 3 markets. I'm like, oh, that's fantastic. How did you do that? He's like, because we only actually entered into we only entered into 2 markets. We've got one domestic one. We entered into 2. I'm like, so how are you in 15? He's like, oh, easy. We just did that all through JVs. Identify a company, same customer base, complementary angle. You start as referral partners. You add value to one another, and then you escalate it. Now I'll talk through this because we've done this ourselves, in how to apply it. So, but this is the important part. You got to kind of start as referral partners to build trust. You lead share, you co-market, you add value, you build trust, and then comes the chat. And the chat is, hey La, why don't we do a JV? Or why don't we basically just acquire you? So the JV, really, really simple and easy. It's like, look, why it makes sense for us to escalate it once you've proven it is for you. So let's just say with the hospitality concept designing company, you come in, Alika, you create a new revenue line. You also bring a new book of clients. Because we're working together, it's just part of a bigger group and there's more of a network effect. But at the same time, Like let's just say you are still in Singapore and this company is in Dubai. It's like, okay, but I can also help to open up opportunities for you here in Singapore. So I'm bringing new clients to the table. I'm creating a new revenue line. I'm helping you actually also have a new market. It's actually a really, really, really like strong win-win. Why don't we just spin this off into a JV because we work significantly better together? And then for you, it gives you access to a new market. They actually have the bank account, so you don't need to go through the hassle of setting it up. And you're also acquiring an existing book of business. Now, I just wanted to say we actually entered Dubai in the same way. We found a company that specializes in go-to-market for tech companies. We worked as partners for about 6 months, and then we had a chat. And it's pretty much like you're currently making money, but we can come in and we can really enhance it. Plus, we open up new markets for you. So let's collaborate. Let's collaborate. We spun that off into a JV where they already have a bank account. So pretty much they just add us onto the bank account. So we're there. They've already got an existing book of business. So we've technically just acquired an existing book of business in Dubai. And the best thing is, I haven't spent a single fucking cent. It's the best. And then let me talk to you about my favorite kind of deal, which is a leveraged buyout. Now, I am an accountant by trade, but I'm not going to give you like complex accounting speak. I'm just going to make this really, really simple and easy and visually to how we did it. So I love it. Basically, it's find an existing business, contribute a venture debt, then there's a loan repayment period, and then you do a profit distribution. So let's say I want to go into Dubai or Indonesia, UK. I find a business. So let's say Elica's a hospitality concept company. They're currently making about 5,000 per month, but they want to be making 15,000 per month. But they've got recurring revenues and the revenues are trending up. So you come in and say, hey, La, I'll help you to get there. You want to be making 15K per month? No problem. I'll give you 15K per month for 6 months. And we're going to do that as venture debt. I'm going to help to give you all of our IP. I'm going to help you with lead generation. I'm going to give you the support. We're basically going to accelerate your revenue significantly during that time. So we're going to put in 90K. We can add in a 10%, like 10K in interest, which is paid much, much, much later. So a total of 100K. So you're currently making exactly what you wanted, but we're going to ensure that the revenues are going to be, you're going to be making the amount that you want, and the revenues are going to be far above that. So basically, when it's above the 15K, that's when the loan starts getting paid down. Then you add on the management fee. So basically, it's 30%. 10% is like a royalty that goes to your holding company. 10% is for the cost of like accounting, lead gen, bookkeeping, back office, and 10% just retain it so you can reinvest further back into the business. So the revenues are growing, you're adding in a management fee, loans coming down, loan gets repaid, great. Now you've been able to help them and the revenues are sitting at 100,000 per month in the market. So what you do is we did this 50-50, business revenues 100K, you're consistently making 15K like what you asked for, the management fee 13%, so 30%. So let's just say round this off, well, let's just make it 24K. So 8K goes to your global holding company, 8K is for like back office support, services, lead gen, and 8K you're just keep to reinvest back into the business. And then your profit is 60,000. So you just do a 50-50 split on profit. They get 30, you get 30. So how that sort of a structure works, like just to explain, we've got our global holding company, and every single subsidiary that you have basically pays a management fee into the global holding company. In exchange, they get lead gen, accounting, all that back office, and they also, what you do to incentivize people to take the deal is you give them ESOP in the global holding company. So you accumulate management fees, and then boom, let's go trigger investment into a new region. So in Alika's case, it's like, okay, cool, we've accumulated it. Now let's put in the venture debt that we can acquire this hospitality design company. So then they come under your umbrella, and then the circle of life repeats itself. Accumulate, 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 Shazam. You go and get yourself a new subsidiary. And in exchange, every single subsidiary gets benefits. So they all get, let's just say, ESOP within the global holding company. So the more of these that you get, the higher the valuation goes. there's a real network effect that happens that the more of them you have, there's a ton of like inbound deal flow and lead sharing that happens. It means that you can go for a significantly quicker exit. And I mean, if you exercise the ESOP, then then they're also getting dividends. So in short, through that kind of a structure, not only have I just acquired a business, they've actually paid for the privilege of me acquiring them, as well as paid me an interest and paid me a management fee. It's the best. So I've entered a new market and essentially had a company pay me for the privilege of being acquired by my business. It's kind of risk-free because they've already got an existing book of business, so you don't need to go completely like net new from scratch. So cool, entered a new market. Here's an existing set of revenues. They're now going to be coming across to yours. And all that I've really done there is just creative deal making. And that's probably the best way that I can explain how to do a leverage buyout. So I guess what I wanted to share is that when it comes to entering a new market, it doesn't need to cost a lot of money. You don't need to pierce like 250,000 up the wall and going and hiring the experienced managing director. You can do it really, really low cost using channel partners as financial managers and board advisors. But you can also bundle it or do it for pretty much like no cost by turning your channel partners slash referral partners into a JV. You've just acquired a new book of business, or by doing a leverage buyout where you not only acquire the existing book of business, you actually get completely repaid everything that you've put in plus an interest. So you've actually made a profit on going into a new market. I'm sorry about the technical explanation on accounting concepts, but that's how you dominate market entry. La.
Love it. Yeah, I mean, I'll be honest, some of that went a bit over my head, but I think if I sort of spent a bit more time with the slides, I think I get it in that sense. But I think it's great. I think, and just the fact that, as you said, you can enter new markets much quicker and eventually, and I guess it doesn't take that much investment either, really, at that point, right? Because you're not fronting that much cash in that sense. You don't need the entity and everything either.
Look, in the case of a JV, you don't need to pay a single cent. In the case of a JV, like let's just say Lika, hey, we're already doing really well here. You're doing really well here. We've worked together for a little time. Why don't we just spin this off in a JV? Because we do significantly better together. In that sort of a case, you're not fronting any cash.
Mm. Yeah, and I was going to say, I've noticed that. I mean, this is obviously larger scale, but I've noticed that a lot in India as well. A lot of the big Western businesses that wanted to enter in India, they end up partnering up with a large Indian company on a JV, and that's how they can establish themselves as well. So it's it's a formula that doesn't just work at early stage either. You can do it all the way up the chain.
Yeah, pretty much, pretty much. Alika, yes, thanks a lot. I get the concept. I need to run over the fee structure again from the second presentation. Yeah, it's trying to break down an accounting concept in simple speak. Do we have any more questions?
I don't know. Let's see. So I know we've got a few people on here that might want to jump in as well. Okay, we've got another one. So do you ever feel like partnerships become distractions instead of accelerators? How do you tell the difference?
Yeah, partnerships can be distractions, but the reality is if you nurture the partners and then the partners are adding value back to you, then it's not a distraction. If it's very, very one way, then it's a complete waste of time. Like as an example, if you're a small business or an early stage business, you're never going to do a partnership with Deloitte. They just don't care, or an Accenture. It's a complete waste of time. You know that a partnership is not a distraction if they're putting equally as much amount of time back into you. And that's something that you'll know relatively quickly. So that's why I usually recommend working with other small businesses. Because if they're putting the time back into you, keep on putting the time back into them. And then you'll know that you're going to start seeing an ROI. If they're not, and you've tried, stop it.
I guess, maybe this is too generic a question, but like, do you like how often do you kind of keep in touch with your partners in that sense to make sure that things are staying on track? Because I think you can obviously have the best intentions, you can have a complementary fit in terms of what your offerings are, but then also you still need to drive that a little bit and make sure that they're also committed to that in the long term as well. Is it a weekly thing, monthly thing, quarterly thing? How do you usually do it?
Well, you should be mutually driving it together. You guys should be sharing deal flow both ways. As long as you're collaborating together and you're also getting back what it is that you're giving. Look, with some of our partners, I don't even need to have like scheduled cadence calls with them because it's normally like, here you go, here's a lead, here's a lead, here's a lead, and then we just do exactly the same thing and reciprocate back because we've kind of got that level of trust.
Yeah.
Um, Whereas with others, or especially at the start, you need to nurture it. At the start, you got to do partnership announcements, you got to do webinars, you just need to spend a little bit more time and effort. Something that works quite well is like, hey, let's go have a catch-up call at the end of the month. And we can do like a tracker. It's like, cool, here's 5 leads that we can introduce you, and you just bring 5 leads that you can introduce us. So that's something that you can do at the start, and then it just kind of starts taking its own form organically. Like if you've got 5 companies that are there on the tracker and then they come empty-handed, just thank you, not interested. Um, if they're also coming into that meeting prepared and then they've got that, then that's when you can start, like at the start, like you can have that sort of structure, but then it's just going to start flowing organically. And then you could just have the chat. Hey, man, you're in this market. We're in this market. We're obviously helping one another. This is obviously growing, scaling together. Why don't we just go spin this off into a JV because we enhance one another? Easy.
Yeah, it's fair. I mean, I'm just speaking from experience of previous companies I worked at where we wanted to partner with people, and sometimes there was a kind of a caginess in terms of like the other partners almost being like, okay, well, when you bring us something, then we'll bring you something. There's that kind of law of reciprocity in that sense. But I think if you're I think doing what you're doing in particular, because I know you as well, like your approach is I'm going to do it because I see the benefit, and it also kind of forces that reciprocity back as well. I think in that sense, because people will then go, oh, well, like psychologically, also we also feel more obliged to help each other out if someone else has helped us, I think too.
Correct. So Robert Cialdini's book Influence, one of the ways of influencing people, it is the law of reciprocity. So if you go out of your way to go help someone else, then they, as long as it's the right sort of person, the vast majority of the time people will then go out of their way to help you. So I just like doing this anyway. I always recommend just go and take the first step. Once you identify the company, go and take the first step to help them. And then you'll see exactly how it's going if they're putting the effort, the time and effort back into you. Um, Very often you'll see that it's not just that they'll put the time and effort back into you. In many cases, we've seen partners return it like 5x the amount of leads and the amount of effort and work that we've put in, they've given us 5x back. As an example, Deal is obviously now a much bigger company than Scalar, and we must have received 5 times the leads from Deal than what they got from us. But why? Because when they needed it the most, when they were still early stage company and we were there in the trenches with them, showing up, sending them partners, doing like panel sessions with them, people remember that sort of stuff. And then they'll actively go out of their way to go and help you. So you will know if it's the right kind of partner. But when you find a partner which is going to be reciprocating back like in exactly that sort of a fashion, it's so much better than just trying to target one customer because one customer gives you one customer, one partner gives you 50 customers, and it's just unlocking scale.
Yeah, I love that. Yeah, and Deal's a phenomenal story as well. I know you mentioned it a little bit earlier on as well, but 6 years to reach $1 billion ARR is just unheard of pretty much in most other markets in that sense. So yeah, they're obviously doing some really good things there. So yeah, I think that's probably another story for another day as well. I'd love to
Well,
tap that a little bit more.
well, that's it, mate. We're on a $1 billion in Vietnamese dong and ARR, so it's
Yeah,
pretty much the same thing.
we got to start somewhere. Yeah, and
Exactly.
there are other questions, but yeah, there was a couple of points that was made in the group as well. Esther and Elika both were saying like great point where you said it should always feel like a balanced energy exchange, and Esther said yeah, structured giving. Evelyn also mentioning also all the E names we have. Saying learning so much today as well. So thank you. So there's a couple of other questions here. So the first one says, "Hi Colin, when entering a new market, do you look for generalists or hyper local specialists first?"
I'm guessing. Is this regarding recruitment?
It's a good point, actually. Yeah. Maybe if they could add a little bit more context to that question. Is it the expansion manager? Is that what you're asking? We'll let them. Yeah, yes, finding
Yeah.
talent. Yeah.
Um, the answer is it depends. It depends. And I'll give you an example. So I remember when I was speaking with a US company that was looking to enter Australia. And I remember I sent them on the recruitment side of business, I'd sent them a profile, and their take was that they wanted someone more local. Now, this is probably it's quite an unusual thing to hear in Australia because it's got a very different connotation to in Singapore with like the
Yeah.
employment passport system. But what they were essentially saying is that the person had only lived in Australia for a year and a half. Um, so how much would they actually understand? To which my case in point was like, it doesn't actually matter. It doesn't matter because what really matters is that they've worked in a startup in a similar space. So for me, I would rather find someone who's actually worked for a startup in a similar space, even if they've only spent like 6 months in a market, as opposed to hiring with someone who's got hyper-local expertise that doesn't have experience in building a similar type of startup. Building a similar type of startup or working in early stage startup, very, very similar, that's honestly, that's the most crucial and integral part. And as long as it's that right sort of a profile where they're hungry, motivated, the hyper-local expertise, honestly, I don't rate it. It doesn't mean anything to me. Yeah, if they're a generalist, so they've never actually, if they're a generalist in the sense that they've never actually, they've worked in just startups as opposed to a startup specifically in your sector, I also don't rate that. So yeah, for me, neither generalist, neither hyperlocal. It's pretty much, I'd say you're a specialist in your particular area of technology. But it just doesn't matter if you're an expert, if you've got that local market expertise, because as long as you know and understand how to scale a similar kind of company, that's the most important part.
Yeah. Yeah, that makes sense. Yeah. Okay, and then we've got another question here saying, when does lean become too lean? How do you know if you're under investing in a market that actually has potential?
You'll see from the financial metrics. If you're generating revenue and you're even hitting profitability in a new region, then just be guided by the metrics. It's look, you spent $1 and you're making $1.20. Start putting in money. Or if you can see the revenues trail, like, let's just say you're making a loss, but you can see that the revenues are tricking up. And it's like, okay, if we add in marketing, SDR, whatever it is, and that's going to accelerate it, then you go and put the money in. I would say be lean until such a time as you can go and be generous. But you shouldn't go and start being generous unless you can clearly see that the revenues are moving up or that you're now starting to make a profit in a new region. So that's what I would say. Like, and I've seen a lot of companies make this mistake where they're still making a massive, massive loss, and they keep on investing and investing and investing. And that's why I don't like hiring that experienced managing director, which is going to ask you to put in more money, put in more money, because you're burning an absolute ton of cash. Where I recommend being lean at the start until you crack the market, start generating revenue, make a profit. Once you make a profit, start accelerating. And as long as the revenues keep on catching up to your new cost base, then keep on putting in more and more and more money. So be lean until such a time as you don't need to be, because it's just pure margin on top.
Yeah, fantastic. And his next question from Adam, it's like you read my mind genuinely. I was about to ask a variation of this question as well. Because I was gonna preface and say obviously a lot of our members, if they're in an early stage position and speaking from experience of talking to members each week now, some of them will tell us, I'm more of an introvert. So they're not necessarily that kind of sales savvy person in terms of going out and hunting and maybe being more aggressive when it comes to approaching partners and things like that. So Adam's question, I think, is right in line with what I was going to ask, which is how do you recommend approaching another company in a similar space? Is there a particular outreach that works that makes the offer compelling enough for them to be interested?
Yeah, yeah. I can tell you now that Adam O'Shea is not an introvert, but it depends on which stage. So, for example, when we entered Dubai, I always start by just reach out and start as referral partners. Very, very simple. We do this, you do this. It's actually completely complimentary. We're looking for a partner that actually does what you do in Dubai. We've got leads that we could send you as well. It's a very, very disarming approach. meet with them, nurture them, and you grow and scale the relationship. And then when it comes time to, if you're looking to then JV or acquire their business, then when you have the conversation, you structure it around them. It's kind of like with the explanation around the board advisor. It's what's going to be motivating. So it's what is going to be the most motivating for you. Is it a particular level of income? Is it a particular goal that you want to hit? Okay, cool. Then let's reverse engineer it. How is it that we're going to help to be able to do it together? And then it's a process of mutual accountability. This is exactly what they want to be doing. And this is exactly how we're going to mutually help the person to be able to get there. So that's a process that I would take. Identify a company, similar custom-based complementary angle, reach out to them, LinkedIn, email, ambush them, whatever you want. Just explain this is the complementary angle. This is how we can collaborate. Our customers are also looking what you're doing. I'd love to share deal flow with you. Very, very friendly and disarming approach. And then when it comes time to the chat, the best way to do it is just structure it around what it is that's the most motivating for the other party. And that's how you get just the true win-win-win.
Yeah. Yeah, and I think even just what you mentioned there, I mean, I'm thinking about it because obviously I've done sales for so many years. Is I think if you come to somebody with a plan, an idea, it doesn't have to be fully formed, but if you've put a little bit of thought on it, I think there's a good chance they're going to respond positively because they think, okay, this person's not just spamming me an email going, want to partner up. You're actually saying, look, I see that you do this and we do this, and you're in this market and I'm in this market, and we've got this mutual fit. It's much more likely to land. And I guess, would you say go as high as possible, right, at first, and then work down,
Go
or
to the founder.
yeah, yeah,
Go straight to the founder. That's exactly that's the person that cares the most about this deal. It's like, yeah, I can completely see the mutual value add. Let's give it a go.
yeah, fair, awesome. Hopefully that answers your question, Adam, and yeah, and also it answered at least I think the one that the members will be asking as well. So fantastic. I know we've hit the hour now, so one thing I was just going to share with everyone as well. So Colin had mentioned it earlier, but we have been partners for quite some time now. And so Scalar, at least, how come Launchpad maybe TBC, let's see. But Scalar have services within the Doer Circle interface as well. So members of Doer Circle can get access to these deals as well. So as you can see, there's a whole custom go-to-market strategy that Colin can help you create through the Doer Circle. And obviously there's a member discount there, which is great. Or if you just want a bit more clarity and you want to have a one-on-one hour consultation, then he can also do that for you as well. Or if you've got something else in mind, something a little bit more in depth, then you can always get in touch a little bit about that. But of course, obviously, Colin, you can find him on LinkedIn, very active on there, always sharing nuggets of wisdom as well. Like I'm always keeping an eye on your post, Colin, as well. So yeah, make sure he's following you. And then I don't know if there's anything else you want to wrap up with on your side as well, Colin.
No. Yeah, book me in. I need your money to pay my international school fees, so help a man out.
Exactly. Yeah, it's not,
Exactly.
living is not cheap, as a few here know.
No, no, it is not. Thank you everyone for joining.
Yeah, thank you so much. And yeah, let's keep the conversation going. I'm definitely keen to, once you've worked on that second part a little bit more as well, we could probably do a even deeper dive on that as well. I think there's so many of our members that aren't in the financial space, right? I've met one founder recently who wasn't a financial director. So for her, it's like, I don't need bookkeeping, I don't need accounting, that kind of thing. I can do that myself. But so many of the founders I speak to, maybe they're like tech experts or retail experts or something, and so for them it's a minefield, how to navigate that financial stuff. Awesome, cool. All right, take care everyone, have a great rest of the week, and look forward to talking to you all soon.
Thank you.
Bye.